Hi, guys, and welcome back to Drive to School Chat, where we discuss a subtopic in geography on our way to school. Now, today, I'd like us to talk about development indicators. And when we are talking about development indicators, we are referring to the ways in which we measure development in a country. And if then we are talking about measuring development, then the first thing that is very important for us to do is to define development. And development is the process by which a country improves or makes progress economically, socially, and environmentally. So we are measuring those three things mainly when we are measuring development, or we are trying to determine how developed a country is. Now, for our specification, there are three main types of indicators that are recommended for us to know. And the first type of indicator that we need to know about are economic indicators. And we have several economic indicators that we can use to measure development, and those we are going to be discussing today. And then the second type of indicators are social indicators. Now, first of all, economic indicators have to do with the wealth of a country. And then secondly, we have social indicators. And social indicators have to do with the way people in that particular country live. So they have to do with the quality of life or standard of living of people in a country. Then the last one that is recommended for our specification is political indicators. So that's what we are going to be discussing this morning. And we are going to begin with the economic indicators. Now, the first economic indicator that we're going to discuss is the GDP. And the GDP refers to the gross domestic product. Now, we know that the word gross means total. And then if we are talking about domestic, we are talking about something that is local. So we would be referring to, because we are talking countries here, we would be referring to it locally as nationally. So nationally within the country. And then product here referring to the goods and services. And therefore, the GDP is the total value of goods and services that are produced in a country every year. So that's the GDP, and it's a good way for us to measure development because it tells us about how much that country is generating. Now, an important thing to mention here is perhaps the fact that countries tend to operate like businesses. So they have ways of getting money, which we would consider to be income for them. So, for example, there's taxation. So there's tax revenue, and the taxes that they collect from businesses or people in the country are a source of income for those governments. And then the government will also have spending. So we have government spending as well, and that government spending is where now the government will use that tax revenue or those taxes they have collected to pay for running the country, for what they need to run the country. So they could be paying for healthcare, for example. They could be paying for education. They could be paying for infrastructure, so like roads and railway lines and so on. So the countries operate like a business. So if we are going then to determine how wealthy countries are, then we are going to be looking at how much money they are bringing in. And that is why the GDP is a very important economic measure of development. So the gross domestic product are the total value of goods and services that are produced in a country every single year. All right, now, when talking about the GDP, we can also consider the GDP per capita. Now, per capita here means per person. And if we are doing that, then it means that we are taking that GDP and dividing it by the population of that country. And that is obviously going to give us an idea of how much everybody in that country would get if we divided the GDP by the population. So how much would everyone be earning in that particular country? And again, that will give us a kind of indication as to the standard of living or quality of life of people in that country. One of the past papers actually talked about GDP per capita, and the students were asked to say what per capita means. So it's important to know what GDP per capita is and what per capita is as well, right? So it's per person. And it's when we divide the GDP by the number of people that live in that particular country. Okay, so that's the first economic indicator. Now, moving on then to the second economic indicator, and that is the GNI. And the GNI is the GDP, or well, GNI, first of all, stands for gross national income. And when we are calculating the gross national income, we would ordinarily take the GDP of that country, add it to the income that is generated by TNCs, so transnational corporations, and then subtract the debt that that country owes. Because when countries need money and they have not generated enough tax revenue, then they will borrow money from elsewhere. So they might borrow money from a different country. They might borrow money from other organizations such as monetary organizations, so to do with money. So like the World Bank, the IMF. The IMF is the International Monetary Fund. So they would borrow money, and therefore a lot of countries in the world are in debt. So they owe money, and they normally pay that debt, regularly. Now, so that means then that the GNI is subtracting that debt from the GDP plus the income that is generated by TNCs in that country. And that again is a way of measuring development, because it shows us what the country will have left after they have paid their debts. Okay, so it's another very important way of measuring the economic development of a country. And of course, all these figures are then compared between countries. The figures for different countries are compared so that we can indicate how developed or not those countries are. And that is how we come up with terms such as HIC, so high income countries, so they're generating a lot of income, or low income countries, they're not generating as much income. Or we could also, say that it's the way we come up with terms such as developed country and developing country. All right, so moving on then to the third way in which we measure economic development, and that is the PPP. And the PPP stands for the purchasing power parity. And the purchasing power parity has to do with the relative value of currency, the currency of that particular country. So it compares currencies across the world and what those currencies can buy you in a particular country. So simply put, it's what money in that particular country can buy you. Now, let me give you an example. We would consider what £1 would buy you in different countries. So £1 in the UK may not be able to buy you that much. But then if you use the same pound to buy goods and services in a country like Malawi, which is a developing country, and which is one of the case studies that we use in our specification, then that £1 would buy you a lot more in Malawi. So that again will indicate to you how developed a country is, because if that pound is not buying you a lot in the UK, then that will imply that the UK is a developed country. But if the same pound is buying you a lot more goods in Malawi, then that will indicate to you that Malawi is a developing country. So that is the purchasing power parity. Right, now let's move on to the fourth economic indicator, and that is the Gini coefficient. And the Gini coefficient tells you how, or measures how wealth is distributed within a particular country. So it tells you about whether the country has wealth inequality or not. And we know that if a country has wealth inequality, then it implies that that country is likely to be a developing country. But if the country has got a more equitable wealth distribution, then that will imply that that country is economically developed. So it's HIC. And therefore, the Gini coefficient is another very important economic indicator of development. And it uses a scale of 0 to 1. And if you're near 0, if your score is near 0, it means, as a country, it means that you have, wealth is equally distributed in your country. In fact, if it was to be at 0, then that would mean that you have perfect wealth distribution within that country. But we know that is not necessarily possible. So most countries that are developed will have a figure or a number that is close to 0. And then the countries that do not have, which have a lot of wealth inequalities, will have a score that is closer to 1. And we will expect that those will be the developing countries, so the poorer countries or LIC countries. All right, so let's move on then to social indicators of development. Now, we said that social has to do with people. And therefore, if we are measuring social indicators, we will be looking at things like literacy rates, so the number of people that are above the age of 15 that can read and write in a country, or we could be looking at, say, life expectancy. So how long people can expect to live in a country. And that obviously will be determined by the healthcare in that country. So if the healthcare in that country is really good, then it means that people can expect to live a lot longer. All right, so those are now social indicators. Now, the main way of measuring social development is the HDI. And the HDI is the Human Development Index. And the Human Development Index measures development using 3 main parameters or indicators. And the indicators it uses, number 1 is income. Then number 2 is life expectancy. And then number 3 is literacy rates. Now, when we are doing that, it means that we are using a variety of indicators to measure development. And if we are using a variety of indicators, then it means that we are likely to get an accurate representation, a more accurate representation of whether that country is developed or not. And therefore, the HDI is considered to be a better measure of development than just looking at the economic indicators on their own. So the GDP, for example, on its own, because we are looking at GDP, for example, be in a country where there's a lot of wealth inequality as well as social inequality. So that would not be a really good, way of telling whether that country is developed or not. But if we use the HDI, then it's giving us an idea of the wealth in that country as well as the standard of living of people in that country, because it's indicating to us how well educated the population is and also how healthy the population is in terms of the healthcare and how long they can live in that country because of the healthcare that they have within it. So HDI is considered to be a better measure of development. So if you were to get that question in the examination, then you would indicate that HDI is a better way of measuring development because it uses several indicators and includes both economic and social indicators to measure development. All right. Now, let's move on then to the third main way that our specification requires us to know about how to measure development, and that is political indicators of development. Now, if we are talking political indicators, we are referring to the governance of countries. So, how those countries are led or governed, right? Because they are governments, and a government leads the country, it's the leaders of the country. And therefore, governance has to do with the leadership in a country. Whether that leadership is an honest leadership or whether it's a corrupt leadership, for example. And then it will also look at systems, the systems that they use to govern that particular country. So is it a capitalist system, for example? Now, capitalist system is where capitalist system is where the politics of a country and the economics of a country. So economic activity and political activity is controlled by individuals or groups of individuals, right? So an example would be America or the UK, because in America, trade is controlled by organizations or people. So people own businesses. They are allowed to own businesses. They are allowed to own industry. So it's a free market economy that is determined by the laws of supply and demand. Now, why is that important? Now, that can indicate that a country is likely to make a lot more development because there is free trade within that particular country. So it's likely that if a country has a capitalist system of governance and that capitalist system of governance is working the way it should, then that country will be economically developed. But if it's not working, if it's not a capitalist system, first of all, it may indicate that that country is not economically developed, because there will be other factors that will come in. So in terms of not just the economic development of the country, but also socially, that country may not be making as much progress. So the people within the country may not be making, may not be enjoying those economic gains. Now, I think that will be better explained when we talk about a socialist system of governance. So there's a capitalist system of governance, and then there is a socialist system of governance. And a social system of governance is where the government owns and controls organizations within that country or the businesses within that country. And the wealth is then shared to the people. Now, because the government controls everything, then people within that country don't own anything. And it could lead to a situation where the people in that particular country, there's inequality within that particular country because the leadership may end up, keeping most of the money to themselves and to the government and not equally distributing it within the country. Anyway, now let's just talk about the main political indicator that we are required to know for our specification, and that is the CPI. That is the Corruption Perception Index. And the Corruption Perception Index tells us how corrupt countries are. And it's supposed to indicate to businesses or investors which countries are the best to invest in. Now, that then means that if corruption is high in a country, then that country is not likely to be a good country to invest in, because it will mean that investors might lose the money that they invest in their country, or they might not make enough gains from that money. They are not going to make a good profit from the money that they are going to invest in that country, because if there is corruption, it will mean or imply that the systems within that particular country are not working efficiently, and therefore trading within that country is also likely to have its own bottlenecks, or have limitations, or have barriers. Okay, so the Corruption Perception Index is the main political indicator of development. All right. Now, let's do a very quick recap then. What have we talked about this morning? We've talked about the indicators of development, and we started off with the economic indicators of development. And the first one we talked about was the GDP, so the gross domestic product, which is the total value of goods and services that are produced in that country in 1 year. Then we went on to talk about the GDP per capita, which is that GDP divided by the number of people in that country, so the GDP per person. Then we went on to talk about the GNI, which is a gross national income. Then we talked about the PPP, which is the purchasing power parity. And then finally, for economic indicators, we talked about the Gini coefficient. Then we went on to talk about social indicators, and the main social indicator is the HDI, so the Human Development Index, that measures income, life expectancy, and literacy rates. And then lastly, we've talked about political indicators of development, and the main one that we use here is the CPI, or the Corruption Perception Index. Okay, so thank you very much for joining me in this Drive to School chat and on this journey towards excellent exam results. I hope that this segment has been useful. Please let me know if there's a topic that you would like us to discuss on our way to school. You can let me know by using the comment section below. Yes, that's winds it up for today. All right, thank you very much once again. All the best, and see you again soon. Bye bye.